Nigeria enters 2026 with improved macroeconomic stability. 2026 marks the beginning of a more robust economic growth. Stability at last, but on a narrow ledge. Stocks up to an upbeat as the market capitalization approaches 100 trillion. When you hear headlines like this, what comes to mind? I'm sure you'll be like, GDP, what is that? Macroeconomic stability, what is even stable? How does GDP even pay my rent? Is that even meant for people like me? And I'm sure when your company resumed this year, you started going for strategy sessions, a lot of meetings, and what they start with, what they always start with, they love it, is macroeconomic outlook. And then you hear things like GDP has grown by X% and we are forecasting that it would stay at around 4.3% by the year end. Brent crude oil prices are now at XX dollars per barrel, but Nigerians' budget has been set with $57 per barrel, but we are foreseeing that it will drop to about $55 per barrel. And you're looking at them like, what are you even saying? And you're hearing things like fiscal policies, the macroeconomic base, and everybody's just speaking like, over your head. And best option, I know you know it, is to either start scrolling or zone off. But before you zone out in your next meeting, let's talk. Hello, professionals, and welcome back to the Stay Well Show. You remember that this podcast is for you to learn about money, mindset, and the modern life without any of the boring bits. And that is why I am here to tell you about the review of all the reviews that you've heard. See, I waited for everybody to do their own review. But because I know, we know ourselves, they have already spoken over your head. So I've decided to come and review the reviews for you in layman language. You know me, I like to make it simple and you can relate with it. You remember that Ethiopian eunuch in the Bible? He had a Bible to himself like that, yeah. He had something, a piece, and he was reading it. And then somebody approached him, that was Philip, and he said, "Understandest thou what thou readest?" If you don't read KJV, why now? And today, I am your Philip. I am here to say, do you understand all the macroeconomic English and jargons you've heard or read in this past 20-something days? So, let's break it down. Why does economic and all its related family members sound confusing? All these outlooks, all these things that people have done wasn't meant for you and I. It was meant for policymakers, investment bankers, fund managers, economists, and analysts. So let me say me, I'm sitting in the position of an analyst today. But guess who feels the impact? You, I, your families, salary earners, business owners, all of us will gather and feel the impact. So please, who should this information be meant for if it's not you and I? So today, we're going to be doing two things. We're going to be decoding the language of all those economic outlooks, and then we'll be translating it into what it really means for you and your money. So let's start with the language. Let's make the economic terms become human. You know that scripture that says the word has now become flesh and has come to dwell amongst us. That is what we are doing today, so that this word will become flesh and you can then relate with it. I'll be grouping this language into 5 buckets so that 20 minutes into the show, your brain doesn't shut down on me. Okay, so we'll look at the first one, the indicators, the macroeconomic indicators, which are like the scorecards for the economy at large. GDP, that's gross domestic product. Think about it as all the monies that entered your bank statement, but this time around it is Nigeria. So that's like the value of everything Nigeria earned or has worked for in the course of the year. GDP growth rate, that's like the percentage growth So, say for instance, they say GDP grows by 4%. It means that, yes, the economy expanded, but you are not richer. There is also per capita income. Per capita income is like GDP divided by the number of people that we have in Nigeria. Do you know Nigeria's population? When last did we have a census? That is not the conversation for today. So just imagine that you have to share money with all your siblings. How much would be your portion if you have 8 siblings? So compare having 8 siblings with having just 2 siblings or one more sibling apart from yourself, and your father gives you 10K. Divide 10K by 8 and divide 10K by 2. Do you get the gist? So that's what per capita income measures. And that's why sometimes we feel like we're still poor, even though they say GDP has grown. Do you get? And then the next thing is inflation. Inflation is the continuous rise in prices of goods within the economy. So imagine that prices are growing, your salary is static, and your bills are what? They are skyrocketing. I'm sure that one is not growth, it is skyrocketing. So that is inflation. So inflation can be divided into three. We have like core inflation, headline inflation, and stagflation. Core inflation is measuring inflation without food and fuel. More honest, because of course, between you and I, food prices are not smiling. But headline inflation just measures everything, and that's what you can really feel in the market. So if you go to the market, you buy food, you buy fuel. If you look at headline inflation, it's typically higher because it captures all these other things. And then stagflation is when we have high inflation, low growth, plus unemployment. That was the boundary Nigeria was playing with. I think that should be 2024, 2025, but the outlook for 2026 looks like we're getting there. So the next thing we'll be decoding is monetary policy. Monetary policies are the CBN's toolbox. You ask me what is CBN? CBN is Central Bank of Nigeria. Part of the languages you hear when you are reviewing those kind of reports is interest rate, MPR. MPR is simply the cost of money or the cost of borrowing. So say for instance, they say MPR is now 27.75, meaning that banks and financial institutions are expected to give you loans at those rates. So borrowing becomes more expensive, but who borrowing here now? The investment be the cocoa of this matter. But of course, that is MPR or interest rate. It also influences investment rates as well. The other one we'll be talking about under monetary policy is liquidity ratio. Liquidity ratio just measures how liquid a bank or a bank should be, really, to be able to meet up with its customer obligations, so that when you go to your bank, you will not start crying because your money has to still be there one way or the other. And there's now this other one around monetary policy tightening, monetary policy easing. It's just a control measure where CBN is trying to control money that is within the economy. So when they tighten it, they remove money. When they ease, they release money into the economy. When there is too much money in circulation, the level of inflation follows suit. So the CBN tries to manage those activities. The next bucket of language that we'll be talking about is around the fiscal policies. And the fiscal policy is the government's wallets. And under this, would be reviewing words like fiscal debt, that is the total amount that government is owing, whether internally or externally. Fiscal deficit. Fiscal deficit is a situation whereby the government actually spends more than it earns. There's also public debt. Public debt is a situation where, it's the aggregate of all the money that government have gone to borrow, whether from China, from Taiwan, from IMF, from AFDB, anywhere that they've borrowed from. All of these things form the public debt. Let's say there is also debt to GDP ratio. Debt to GDP ratio is just measuring how much debt against the total income that the government has. So imagine that government has a loan of 8 million but has income of 10 million. You know, that's far better than having loan of 8 million and having income of 2 million. I don't know if we're on this table, but let me just be going. And lastly, we'll talk about subsidy. Subsidy is the money that government gives or puts on the table so that prices can be well managed. You remember, we are going to remove fuel subsidy, and eventually it got removed. And what happened to prices of fuel? It just jumped. And that was what happened in 2023. The next language we'll be decoding is the language of global trade and investment. And there you hear things like balance of trade. Balance of trade is just you looking at the total imports versus total exports. So imagine that Nigeria imports rice, matches, toothpick, and all of those things to a tune of 50 million, for instance, and then exports cocoa, cashew, and those commodities to a tune of 2 million. Did you balance? Answer for yourself. The next thing that you can see under this bucket is FDI, FPI. You ask me, what does this mean? FDI is foreign direct investment, which is when foreign entities come to invest in businesses. The money stays, it is used for business in Nigeria. And FPI is when foreign counterparties or foreign entities come to invest in instruments, securities such as stocks, bonds, sharp money, they cash out, and the money leaves. Which one is better? Answer for yourself. Social realities. Under this, we would have things like, cost of living crisis, and that's the situation where, of course, expenses are growing faster than income. Another thing we can talk about here is unemployment. Unemployment is where people that are eligible and able to work are finding work but cannot find any. Like you're looking for work, but you can't find any. There is also underemployment. Imagine a graduate driving keke part-time, like keeping mind and body together. I don't know if this is Nigeria, but and then we have the poverty head count ratio. That one, imagine that out of 10 people, only six is plenty. Let's say 4 can afford to meet their own, let's say, cost of living. And then we have real income. Real income is, let me just say, you earn 100k. I like to use 100k, Abby. You're earning 100k, but when you want to use it, it then looks like it's just about 60k because, of course, the economy has adjusted for inflation under your salary. So that gives you your real income. When you adjust for inflation, is your real income. And that's like the value of what your money can actually buy in the market. So I hope you understand all of these languages. So when you see them in economic reports, you are not perplexed. And you're not like, all these things are not meant for me. Yes, they are meant for you because it affects you the most. Let's quickly look at 2026 macroeconomic outlook. I hope you are not scared now because, yes, I've explained everything I'll be talking about in a couple of minutes ago. So the first one we'll be talking about is economic growth. And one way to measure economic growth is using GDP. What is GDP? I've told you before. Gross domestic product. Currently, it's standing about 4.7%. It's growing, but it's not booming. And why is it not booming? It's not booming because the other things that are supposed to support it. Imagine that we have infrastructures, people are employed. There will be higher income to earn, right? Because there are services that are being deployed. But of course, because of the way Nigeria is, yes, we are grateful that it is even moving ahead. For inflation has cooled down. I recall that it entered about 34%. So now it's doing around the 14s and the 15s. Yeah, I'm sure you say, but prices didn't fall. Yes, prices didn't fall, but at least it is slower. Like the jump is not as bad as before. So imagine fuel prices. Fuel prices is now averaging 798, 805, 850 in those ranges. Yes, fluctuating, but imagine when it was 1,000 plus. Do you get? So those things are evidences that prices are actually dropping. Imagine FX prices that jumped to about 19. I think it was entering 19 at some point. I'm not sure it touched 2,000, but now it's back at 1430. It stood at about 15 for a while, but now it has trended downward. So those are evidences that yes, prices are actually dropping. Imagine rice. I think at some point a bag of rice went for about 100k, but now you can still find rice at 50k per bag. Do you get? So those are the evidences that inflation is trending downwards, and yes, it is also being reflected in the rates that is being published by the economists. So like I mentioned, exchange rate, for instance, volatility has improved, because before, any small thing like this was just going up, but now it has, Yoruba people say, "Oti sharajo." Yes, it's now compact, it is slower, and we are not experiencing all of those jumps. And I think one of the things that also helped with exchange rate volatility was the unification of the exchange rate. Unification in that there was now one rate. Everybody uses either NAFEX rate or nothing. Do you understand? And then that helped the exchange rate volatility, because people were good at using speculation. MPR is currently at, I think, around 27%. And what that means is your borrowings is at 27%, which is still really painful, you know. Let's drop it to single digits and people would start borrowing, SMEs will be happy, and all of us will be happy. But be that as is may, it is well. The other thing is government finances. Yes. How much have your government borrowed? The budget came out last for 2026, and it was around 58 trillion that were supposed to like use within the economy, and 23 trillion out of it is going to be borrowed. That means that half of the budget is going to be like it's on deficit. So what that means is one out of every two income that is earned within the economy is going to be used for debt servicing. And these are part of the reasons why the GDP would not grow as fast as we are expecting to see. Let's talk about the markets. Market is moving in a very serious manner now. That's, I mean, the capital market. Imagine market capitalization getting to about 100 trillion, and it has not stopped. So, what is that telling you? And guess what? There has also been new capitalization instructions that have gone out to capital market operators, issued by the SEC. SEC is Securities and Exchange Commission. So people like stockbrokers. Remember those guys we talked about in one of those episodes where I analyzed the capital market operators using families? Yes, if you did not watch that episode, this is the time to go and watch it, so that you know the people that that capitalization is affecting. But imagine that the capitalization of a company is moving from 150 million to 2 billion. Can you imagine that? So what that means is there would be public offers, there might be M&As, mergers and acquisition, there might be rights issues for these companies to be able to meet up with their capitalization requirements. So position yourself in 2026, because ownership is going to be better than salary. Do you get? So yes, that market is one to look out for, because it is a booming segment. Don't be deceived though. Don't let anybody tell you that it has gotten to its peak. It is still a way to go in 2026. Let's talk about oil and risk, and the risk that are associated, because truth be told, the Nigerian economy is still highly dependent on oil. So that means that whatever external shock that is happening in the world market, you remember that story around Trump and the president of the other country. Let's not go into that. But yeah, whatever happens, if there is production in Venezuela, for instance, more production, Saudi Arabia, everybody brings their crude, price falls, and Nigerian budget is saying that, oh, we are going to have to sell at 57, but when global oil prices drop to maybe 55, there's already a deficit there. Do you get? So that is also going to affect what the economy is bringing to the table for us as individuals. So in view of everything we have said, you would agree with me that yeah, the economy is going to be better But that does not necessarily equate prosperity. Because if I say, oh, inflation has dropped, but has it really impacted you and I? So that would mean that owning assets, improving your skills, and getting better at what you do would matter way more than those headlines that you've seen. So let's quickly look at what this means for you, really, because I know that's the question you're going to ask me. As it boy, education, you what's the control? How does that affect me? 5 things a smart professional should be doing in 2026. Stop ignoring economic signal because that might be your cue to wealth. Number two, shift from survival to strategy. This year is no longer about keeping the head above the water. Number three, move from income only thinking to ownership. You can own stocks even with 5 kobo, depending on the one you want to buy. Number four, structure your finances intelligently. No emotions in 2026. So. Number five, build resilience, not predictions. Yeah, or that like to pick numbers. You know yourselves. And everything I have said today can become very overwhelming. Like all these economic signals, you say we should stop ignoring it. I don't even have time. How do I look at all of these? How do I analyze financial statements? Because you're saying I should go and buy stocks. That means I'll have to check out the revenue. I'll have to check the profitability. I have to check growth trend, DPS, DPS. What's all that? And you can actually get overwhelmed. And that is why we are building the Stealth Wealth Network. No jargon, no noise. It's just going to help you structure your life, like structure, community, and impact. That is what the Stealth Wealth Network is about. I am putting it out there. Anything you do without structure is likely going to overwhelm you. And in the last episode where I said hard work without structure is going to leave you feeling exasperated. So look out for the Stealth World Network, where you're going to be helped with your finances in 2026. I'm glad you stayed till the end. Stay tuned. Like, share, and subscribe. And don't forget to turn on the notification because that is how you know when the next episode comes. And by subscribing is how you know when the Stealth Wealth Network actually opens up to you. Because this year, we are going to do things differently. And of course, without the noise. Till I see you again next time. Bye.